A really important role within your business, whether you're running a manufacturing, a construction, or a wholesale/buy and sell business, is the procurement manager, the person who's responsible for buying either the product or the raw materials that go into what you sell. They've got to find a balance between satisfying the needs of operations, so what we're eventually going to sell, while also not running out of cash by buying too much stock. As you would have seen in previous videos, we talk a lot about key performance indicators that we use to measure the levels of performance that are being achieved by departments within a business. Procurement is one of the most challenging. For example, you could use fill rate as a key performance indicator within procurement. Fill rate is the percentage of sales that you lose as a result of not having the stock in your possession. For example, if you receive 100 orders and you're able to deliver 98 of those orders from what's in stock, then you've got a fill rate of 98%. But what is the problem with fill rate? If you take it to the absolute extreme, is you end up with that procurement manager who buys mountains and mountains of stock that ends up sitting there and bleeding the cash out of your business while building a museum full of stock. Another KPI that's used is days stock. This is looking at, on average, how long does a piece of stock or raw material stay within the business's possession. If we receive it today, how long until it's consumed and sold to the client? For most businesses, this can range from anywhere from 60 to 90 to even 200 plus days. The challenge with this being the KPI is if we want to keep this as low as possible, we could end up with a procurement manager who doesn't have enough stock to satisfy the demands of operations, whether it's through selling or manufacturing. How do we solve this riddle? Not running out of cash while still satisfying the needs of operations and sales. This conversation came up in a finance meeting recently, and a client actually came up with an awesome idea which I'm going to share with you now. It's looking at a KPI that mixes the two of them together. Let's break it down. The first element is looking at your monthly sales as a percentage of your total stock. So the calculation being monthly sales divided by your stock. The second part of the equation is adding your monthly revenue divided by your budgeted sales. Once you've added those two percentages together, you might end up with 175%, 200%, 85%. When you add those two percentages together, you then divide it by 2. As we always say, to influence an outcome, you have to understand how it's calculated. The first part of the KPI, monthly sales as a percentage of total stock. This is our way to capture minimizing the amount of stock that we hold, but also comparing it to how much sales we do in the course of a month. Let's look at a hypothetical example. The first element, the monthly sales as a percentage of stock. Let's say we had $1 million worth of sales or revenue for the month, and we hold $1.5 million worth of stock. So it'll be $1 million divided by $1.5 million, giving us 66%. The second part of the equation is then going, what was my revenue for the month as a percentage of my budget? So the $1 million of revenue, and our budget, in this case, we're going to say is $750,000. So we've beaten budget. So $1 million divided by $750,000 gives us 133%. We've clearly gone better than we expected. So adding those two numbers together gets us 199,000. For the ease of numbers, let's say it equals 200%. We divide that number by 2 and it gets us 100% is the number we've achieved. Now, what is the significance of this number? Firstly, let's look at revenue versus budget. If we've got a procurement manager who isn't buying enough, who isn't able to provide goods when the team need them to satisfy clients' demands and requests, and essentially our sales, then that percentage is going to be compromised. Also, you might be saying, well, how does that person impact sales? I believe that there's no islands within a business. Procurement helps sales, operations help procurement, finance helps every other area of the business. All these things come together to build a great business. Therefore, that equation, even though it's not entirely procurement's responsibility, they have a significant role to play. To conclude on the second part of the formula, naturally we want to have our actual revenue exceeding our budgeted revenue by as much as possible. Let's jump back to the first part of the equation though, our monthly sales as a percentage of inventory. Now here there's a little bit more nuance, and what I would recommend is you backtrack what the number in your business should be. If we're going to backtrack this number within our business, how do we benchmark for it? Not every business is the same. As I said a moment ago, when you're looking at actual revenue versus budgeted revenue, clearly we want that percentage to be as high as possible over the budgeted revenue. There are elements of the first part of the equation that will impact the percentage that we aim for our business specifically. Firstly, how long do we expect to hold stock for? A business that imports a significant portion of its product or materials is going to hold stock for a longer period than a business that gets its product locally. For example, if you're importing a significant portion of your raw materials or your product, 150 days might be a really good metric to aim for how long you hold stock, considering the risks associated with shipping and getting more stock in the future into your possession without running out, versus a local supplier you might strive for 60 to 90 days because you can turn that stock over quicker because of how short the shipping is relative to an overseas supplier. The other factor when benchmarking this for your business is how high or low, relatively speaking, is the gross profit or contribution margin in your business. A business that has a higher contribution margin, a higher gross profit, will rely and require less stock than a business that has a lower contribution margin and a lower gross profit. So quite simply, they're going to need to hold a greater amount of relative stock dollars for their sales because they consume more stock to create that sale. If you've got a contribution margin of 60%, and let's say that's all materials, 40 cents in that dollar of sales will be at some point in time stock. If you've got a contribution margin of 40%, well, at some point in the past, a dollar of sales would have had 60 cents in stock. Clearly, that second business is going to be more stock reliant than the first, just by the mathematics. As we touched on before, I recommend backtracking this number in your business to work out if I want to have stock days at 150 or at 90 days, or whatever that number is you believe is fair and reasonable while managing the risk of not running out of stock. That should be the catalyst that you use relative to your revenue that we strive for. So in summary, the first part of the equation, work out what a strong benchmark for your business is, and also look at what it has been in the past and where it could potentially be. And then the second part of the equation, looking at our budgeted sales versus actual sales, naturally we want that number as high as possible.